have a very, very important guest to introduce you. Yeah, Mr. Ramesh Mantri, who is the Chief Investment Officer of Whiteoak Capital Asset Management Company. Mr. Ramesh Mantri has 19 years of experience in investing and financial analysis across sectors. Ramesh had founded Ashoka Capital Advisers that advise the fund and family offices on equity investment based out of South Asia. Prior to that, he was part of the two-member team which invested in South Asia in equity and debt for Alden Global Capital, a US-based hedge fund for over 7 years. Prior to that, he was also an analyst at CRISIL, which is India's leading rating agency and covering the financial sector. Mr. Ramesh is also a CFA charter holder, and he is an MBA from Faculty of Management Studies, Delhi, and he is also a qualified chartered accountant. Funds managed by Mr. Ramesh Mantri in Whiteoak Capital Mutual Funds are Whiteoak Capital Flexi Cap, Whiteoak Capital Big Cap, Whiteoak Capital Tax Saver, Whiteoak Capital Large Cap, Whiteoak Balance Advantage Fund, as well as Whiteoak Capital Multi Asset Fund. Welcome, Mr. Ramesh Mantri.
Thank you, Venkat. Thank you for giving us the opportunity to talk on this show.
Yeah, so it was our pleasure, sir. So today I wanted to ask questions on behalf of my client. And my first question is that Whiteoak as a mutual fund has done a detailed research on the SIP analysis report. Could you please explain the findings of the report for the betterment of the investment community?
Yeah, so first of all, I think, in the last decade, from 1,000 crores, this has now become a tsunami and has become the preferred way to invest. Like now we are tracking close to 15,000 crores a month.
Yeah.
So this is the most preferred and the best way for investors to invest in mutual funds. It's a great way to save money and also to manage the volatility that markets deliver in the short term. So actually, interestingly, people don't realize SIP is actually a way to benefit from the inherent volatility of financial assets. Most other products, investors tend to get harmed by the volatility. But actually, the SIP is a way to actually benefit from the volatility. So that's first thing to understand. There are a few key observations on our SIP study. The first observation is often people tell us which day of the month you should start an SIP. The answer is it does not matter. You can choose any random day out of 31 days. And if you invest long enough, it does not matter which day you start. It is important you start. People ask this question whether you should do SIPs on a monthly basis, fortnightly, half yearly, weekly. Again, the answer does not matter. The important thing is you do an SIP, right? So returns don't matter. The other big question comes is how long one should invest in SIP. See, I think it's important to understand here is that equity markets and financial assets in the short term are inherently volatile. But as you expand your time horizon, you start experiencing the benefit of compounding, which the markets deliver. So you need at least a 5-year period, minimum, at least from an equity perspective, to even start investing. So you need at least a 5-year commitment to significantly improve the odds that you will experience one, positive return. Number two, at least earn 10% or more returns based on historical data. But actually the real period is actually 8 years and above. That is where really the benefits of SIPs kick in. And mind you, the real benefit of SIP is people don't realize is when markets are flat or markets are down. That is when you get more value for your SIP. So it is like we all love to buy in a sale, right? When our favorite brand is on sale.
Amazon, people 40% sale.
40% sale, and now the monsoon is the season for sale for a lot of brands. But invariably, investors tend to get frightened when equity market you get a discount because of the nature of the markets. And SIP is actually a way to benefit from that sale that occasionally happens in markets. So you need at least an 8-year horizon. The other question is which product. Since, as we're saying, we need at least a 5 to 8 years minimum horizon on SIP, we looked at long term the performance of different funds from large cap to flexi cap to mid cap to small cap. From a risk adjusted basis, considering the returns and the volatility based on historical data, the best product is to be in the mid cap fund. See, mid cap is a very interesting place because it's neither too big that you have a growth constraint, neither it's too small that you will have you will have problems of scaling up, you will have management problems, or you will have a problem of the industry size. So being mid cap is just the right balance of risk and reward for people who can at least take a 5 to 8 year perspective through an SIP. And that is why at White Oak, the mid cap fund that we offer is investable only through an SIP and STP.
Yeah.
And I'll tell you why, because this is very important. Why did we, and we bought this feature on day one when we launched, after the NF4, this feature. The reason is not we are putting a constraint of SIP or STP, not because the fund was large or we are capacity problem to manage the money. Often it happens with small caps and all, or mid caps, small and mid caps, that people tend to get excited about these categories after this category has done well. And then they invest a lot of money. And as we know, mid caps are more volatile. There's a period of volatility that emerges. We have seen that only a few months ago, where small caps and mid caps were not doing well. And of course, they again started doing extremely well in the last 3 4 months.
Yeah.
So during that phase of underperformance, people exit the funds, they have a bad experience, and then they find problem with the product of the partner or even the manager, right? But inherently their own behavior that harms because they invested a lot of money. If you had invested in SIP in a mid cap fund over a longer period, because you're only investing a part of your savings every month, you would have stayed invested even during the tough period. And you give it a long enough period, and then the magic of compounding comes into play. And then investors would have good experience. And that is a win win outcome for everybody. And that is what creates a loyal investor in the mutual fund. When investors
Perfect,
have
sir.
a great.
Your SIP philosophy was very well understood, sir. Now I would like to ask a specific question pertaining to your AMC, which is the art and science of investing, which White Oak advocates. Can you throw some light on that?
Yes. So, the investing world, when people talk about investing, it is filled with folklore and stories that you invested 30 years ago in certain company, right? And your money grew 100 times or 1,000 times. But those are the stories that are told to excite people about investing, right? Now, those are just stories and single incidents or anecdotes. That is not how investing is. So it's important to understand that there is an art in investing about identifying the investment opportunities. But there's also a science in that process, both from identifying investment opportunities, and the more important part is about how do you construct portfolios and how you manage risk. For example, I'm first coming Venkat, to at your level, at an advisor partner level, all solutions don't suit every investor. What is their asset allocation, what is the right products for them, is in the context of their financial position, their experience with investors, their genuine risk appetite, and not just financial ability, but behavioral ability of taking risk.
Yes.
We always have to
Yes.
build portfolios in that context. There is no one answer that works for everyone. Similarly, when we invest, right, while we have to use the art, which is having extremely talented people who are practitioners of the art, but there's also a significant amount of science in investing. And let me talk about a few of these, right? For example, let me give an example of, let's say, first talking about valuations and how to think about valuations. Now, often people use very easy shortcuts like P multiples, EV beta multiples. Often you see this number called EPS, and people tend to talk about valuation from these frameworks. At Whiteoak, uh, we have built a proprietary framework to, we believe all these approaches have their value, but they're also flawed, and they are better approaches to understand how value is created in businesses, and then how to value that different elements of business. So we have created a proprietary OPCO FinCo analytical framework to analyze and value businesses. And every business that we invest in, every company that we evaluate, we put this on this framework to understand the different components of value creation. It is not about stories. It is not about narratives. It is about numbers, hard numbers. Number two, coming to portfolio construction, like you can have different elements of portfolio construction. For example, there are people who take very large sector bets in their portfolio. They take a top-down view. This is the year of banking, or this is the year of capital goods, and this year one should not invest in IT or pharma because there's a likely recession in the US. Now, we know from a lot of data and experience now that a lot of these top-down bets, whether market timing or picking the sector, right, is like flipping the coin in a match of cricket. Half of the time you'll be right, half of the time you'll be wrong. You don't want
because
a
we are
cricket
living
player
in a VUCA
spending.
world, basically.
Yes.
Yeah.
The important part is you don't want cricketers practicing tosses.
Yes.
You want cricketers to spend time playing better at the game. So all this top-down macro investing, right, works half of the time. Like, for example, people have been all recently talking about how difficult the IT sector is with the recession, right,
Yes.
with lower deals, and also the risk of generative AI and all. And yet you're seeing what has happened recently to IT
Yeah.
stocks.
Nasdaq
So
has bounced back.
it's hard to predict. So
Yes.
one, top-down bets, you get them half the time right. However, if you build a portfolio which is bottoms up and which is invested in all major sectors
Sectors.
of the market,
Yes.
then you'll always be invested in the best performing sectors, a part of your
Correct.
portfolio. So that kind of portfolio construct allows you to deliver consistency of performance. See, it's great to be a hero, by taking big bets. But remember, people who end up hero also half of the time end up becoming zeros, right? And investors, while they like the hero fund, what they hate the most is the zero fund. And they tend to exit funds which have not done well,
Yes.
particularly in during periods where these things don't work. So it's important that investors stay invested, and that is why consistency is very important. So this balanced portfolio construction across sectors helps you to deliver consistency. Similarly, there are a lot of other factors that are required for consistency. For example, there are years where the global economy is doing well, so globally export sectors will do well. For example, auto ancillary, IT, pharma, and there are years where the global economy won't do well. Similarly, there are years where pro-cyclical sectors will do well, like banking, metals, commodities, or capital goods, real estate. And there are years where defensive sectors like IT, consumer, pharma
FMCG. Yeah.
would do well. Now, if you build portfolios with one kind of bets, when they work out, you're the hero. When they don't work out, you're the
You
zero.
become zero.
But we believe a portfolio construction that manages and appropriately sizes these factor risks helps you to deliver both alpha outperformance and also consistency of performance, both the objectives. and which is a good outcome for investors.
Correct.
So you can talk about the science at valuations and identifying businesses. For example, one of the important things is often people tell which company to invest in. I think the easier question to ask is which company not to invest in. In
Yes.
life, avoiding bad things, bad mistakes,
Is good.
much easier,
Yeah.
right, than to do the right things. For example, when you have a medical problem, doctor will tell you what not to do first before he
Yes.
tells you what to do. He'll tell you what not to eat, because that's
Yeah.
much easier to avoid.
Correct.
So, you know, portfolio construction is a science. I'll just give you an example of diet.
Yeah.
Whenever you go to the Western world, when you go to international, you go to Western QSR, whether it is McDonald's, and ask for a meal, you typically get a burger, you get a fries and a drink like Coke.
Yeah.
If you go to a KFC, again you get three items including the Coke, chicken, and all. Right? If you go to a Subway, you get a sandwich, chips, and a Coke. So the Western idea is three items and meal is over. If you go to anywhere in India for a meal, whether it is Chennai, whether it's Mumbai, whether it is Delhi or Kolkata, at a lunch or dinner time, you'll get a local thali, which will have at least 15 to 20 items in the meal. Why do we have 15 to 20 items? Why do Indians eat thali? If you ask any good dietitian, they'll tell you the good diet is eating variety of food every day. That is what the Indian thali is. Small, small portions of variety of food. You have sweet also, you have rice also, you have chapati also. So that is what you have to build portfolios, where you have variety of attributes in the portfolio, which is the science of portfolio construction. So at Whiteoak, our funds, let's say a Flexi Cap fund, is designed to be the thali, the Indian thali, which is good for your long-term health. So this
Very
is
well
the
explained on the concept of art and science of investing, sir. And I also
yes.
noticed there one unique fund you have, which is the multi-asset allocation fund. See, the majority of the fund houses, what they have is they have 65% to equity, the remaining in either a combination of international assets or a gold and debt, like that. Whereas you, as being true to the label, you maintain it with the equal proportion. Can you throw light on that? And along with the
Yeah.
benefit of that new indexation which has come in post
Yes. So
2023
yeah.
April. Yeah.
Yes. So the idea of multi-asset. See, I think it's important to understand that you know chemistry is a very interesting space, right? Uh, if you add one atom of carbon and two atoms of oxygen, you get carbon dioxide.
I would say. Yeah.
But if you add one atom of carbon and one atom of oxygen, you get carbon monoxide, which kills
Monac.
us,
Yeah.
right?
Yeah.
Uh, so just changing one atom in chemistry changes everything from life giving to life taking, right? So similarly, in financial assets, you can combine various assets because every asset has a different property. And if you can combine in a right proportion, you can end up with different risk and reward. So the idea of creating multi-asset funds is that you move from people buying one product to people start focusing on solutions. So this is a very interesting product where we have four asset classes that come together: domestic equities, foreign equities, debt, and gold. And the idea is not to just have a 65% in domestic equity and have 10% in foreign securities or gold and just make it a three asset class. It has to be truly a multi-asset fund, which means you get the benefit of diversification across asset classes. I'll give you an example, the beautiful relationship that domestic equities have with gold. So you'll be surprised there's a very good negative correlation between gold and domestic equities of minus zero point 0.5. That means that in years where domestic equities does well, gold does not have a great year. But the more important part is the rare year, the 2 years in a decade where domestic equities does poorly, invariably gold has a very good year. So when you combine gold and the domestic equity, you get a very interesting hybrid that tends to set off their negative return attributes, and collectively they reduce the risk. So interestingly, when we combine these four asset classes, if you look in the last 12 years and we look at the last 12 years of data, every asset class individually goes through a period of poor performance, at least 2 to 3 years in a decade. But when you combine these four asset classes together, right, in the last 12 years of backtested data, you don't have a single year of negative outcome.
Negative returns. Correct.
And people, and I think we as investors underestimate how much people hate negative returns, because people hate the idea that you have a red in your portfolio in a particular year. So this is a very interesting product. On a it's because of its design and changes in recent tax laws. On a 3-year basis, it has the advantage of what is called the debt taxation, where you get the benefit of indexation benefit as per current tax laws if you hold it for 3 years. The objective of this fund over time, we believe, is that it should deliver objective, that is our aim, that it should deliver debt kind of volatility on a 3-year basis, and returns should be better than debt, slightly better than debt over that period. And because of this indexation benefit, it's a very interesting product. And I'm giving a very perspective. If you individually invest in gold, you end up with very different taxation. If you invest in each of these asset classes separately, you end up with very different taxation. But here you have this advantage of taxation. So it's genuinely a multi-asset fund rather than just buying small exposures into asset classes and predominantly being an Indian equity fund.
Perfect, sir. And I also wanted to add that when you talk about the gold return, it has to be on dollar denominated, because people tend to make it as rupee denominated because gold is an international asset. So that also has to be considered.
Yeah, that is very important to understand. Gold is actually an international asset. Gold is not a domestic asset.
Yes, true. Very well, sir. I got your point on the multi-asset solution. And see, when I look at the Whiteoak history, it is actually having a very good track record on the PMS and AIF front, which is also regulated by SEBI. And for HNI investors, why do you think that they should have PMS AIF in their portfolio? Because some of my HNI investors do think that I have a good amount of mutual funds, let me continue with that. But there are some unique value propositions in PMS and AIF. Can you just give me, and do you have funds in India, abroad also?
Yeah, see, I think it's important to understand that the mutual fund product has every kind of investor, from the HNIs to a normal person, including people who do monthly SIPs of 100 rupees a month.
Correct.
People for them who are first time to the mutual fund or capital markets for the first time they're investing. So the mutual fund product is designed to cater to every kind of investor. So and volatility expectations are very different. So we tend to have much tighter risk management on whether it is single stock exposure, single active exposure, sector bets, industry bets, group bets. We tend to have much tighter risk management in how we run the mutual fund. The advantage of a PMS AIF is, first of all, this product only caters to HNI. HNIs, by definition, most of them understand equity and risk taking better. They have larger risk appetites. And so the PMS and AIF, by regulation, also have a lot more flexibility on their risk taking, unlike mutual fund, which are bound by very stringent regulations in terms of what kind of risk they can take. And that is why there's a potential for PMS and AIF to deliver better returns at the cost of higher volatility. So if people are comfortable with their risk appetites, then they should really consider the PMS AIF product. The mutual fund is designed for lower volatility, and in the process there is going to be some trade-off on return, but that is what a lot of mutual fund investors want.
Perfect, sir. Point taken. And before I end the session, any final thoughts to my investors on their investment journey and how important for them to tag their investments with the goals, and how to stay invested in this VUCA world?
No, I think first of all, I think the single biggest driver long term of creating portfolios is you have to save money, right? Number two, everybody needs a great financial advisor, because just like when we have medical problems, we go to doctor, we have legal problems from lawyer. Most people wrongly think that they can manage their money own. But this is as professional a task as anything else. Just like we hire architects, you need to hire a capable, trusted professional and then follow their advice. And number three, I think every investor in India needs to invest a lot more in equities. See, when people put money only in low risk products, whether it is through insurance or bank deposits or even fixed income products, effectively that money goes back, get channelized to entrepreneurs in India. Please believe in the India story and bet with Indian entrepreneurs. The last 30 years have been great for India, despite every kind of thing that you can worry about, whether politics, whether geopolitics, whether oil price volatility, crisis, scams. India has done very well. So there's no reason to believe for the next 20, 30 years, India will not continue to do well. Please believe in your country and your entrepreneurs. So invest in equity. So it's important to get started, and in my opinion, for a lot of investors, SIP is a great product, great way to get started. And in this context, I'd like to say, I don't know, Venkat, if you heard of this poet called Kabir from India, from North India. I'll say these lines in Hindi and translate in English the lines. So the lines, there's a famous, which is say, so I'm going to say it in Hindi and then translate it into English for the benefit of audience. Bull में सब invest करे, bear में करे ना कोई. So everybody invests in a bull market, nobody invests in a bear market. पर जो regular invest करे, wealth काहे ना create होए. The person who invests regularly, why will he not become wealthy? So investing is not about bull and bear. It is about investing regularly. That is how you create wealth.
Very well, sir. Very well. And we are enlightened with our deep analysis on various processes, functions, and how do you select funds and your investment philosophy. We thank you for sparing your valuable time for the session, and we look forward to connect with you more in the times to come also. Thank you very much, Mr.
Thank you for the opportunity. Thanks a lot.